Good afternoon. I'm Frank Congilose. I'm the managing partner here at C&A Financial Group. It's my pleasure to be with you this afternoon. I'm with Bob Farrell, Chief Investment Advisor here at C&A Financial Group and one of my partners. So, Bob, always a pleasure to be with you and spend time with our clients and our friends and all of our, the C&A community. Today is Monday the 10th, kind of an interesting day. We came out of an interesting week last week, which is, there's a lot going on in the world. I know from, time to time, markets go up, markets go down, and, we've been dealing, with a lot of, I would say some nuances that we haven't seen in a while, and some of the nuances is we have a new administration. Changes that are going on in the administration have people that are getting concerned about things. They're talking about tariffs and all of that. And here we are Monday at the end of a day. And when I looked at my screens before, there was a lot of red. And it's not that I don't like red, but it's one of those if I prefer not to see as much as we saw today. And so we thought the fastest way to get an information out to everyone and to give some insight was really to just share some time with you this afternoon, give you our insights and so forth. And in saying that, I'm 40 plus years in this business. Bob, you're how many?
Very close. Right behind you.
So having said that, we're not new to this. And what I'm going to tell you though is that, every time that we go through market volatility, we go through things that are going on in the economy, things that are going on in the world, it's always different. Okay. There's always an event. There's always this, perhaps not even an event, speculation or emotion that actually has people doing things with regard to either buying or selling stocks that drive the markets up, down, or whatever way. And so, having said that, I thought it'd be a good idea if we just spent a little time with you and give you some insights, some thoughts, and some perspectives. And so, as we wrap up, again, the market just closed, and again, I saw a lot of red on there. It was a pretty crazy day. And Bob, I know that you have the details, so maybe we'll let you just share a little bit.
So it was the S&P was down today, a little over 2%, 2.5%. The Dow, which is not a great indicator of 30 stocks, is 2, and the Nasdaq at one point was down over 4.25%. So a lot of red weighing on the market. Cryptocurrency was down 6%, 6.5%. And again, this is a little different than other times because often what occurs is there's an event and the market reacts to an event.
It's like we've had,
it could be a mortgage crisis.
We
It could be a
had
terroristic
COVID,
attack.
we had banking,
Right.
savings and loans, we've had numbers of things, but at the moment we don't actually have an event.
No, we're not seeing that. It's the market's reacting on what could occur. And they are concerned about tariffs. They're concerned about a slowdown in the economy. They are concerned with cryptocurrency in particular. It advanced a little bit because we felt that we'd be the crypto capital of the world. In all reality, we are, but we're not going to buy any crypto. We're just going to take the crypto that we had harvested and use that. So effectively confiscate it. So it's not like we're going to buy new assets with crypto. We're just going to take the crypto that was.
We're going to reallocate.
That's exactly right. And I think kind of disappointed the market, but we're starting to see signs of slowdown. And I think that's what has the market upset a little bit. We have inflation that's sticky, and it's going to be tough to get that to a level the Fed's comfortable with. And we have our labor market that's starting to show signs of weakness. And I think that's good long term for inflation because wage inflation won't be as strong. But from where we were 2 to 3 months ago versus today, I think the market is starting to say, is the consumer slowing down? Consumer stocks or like airlines got hit today. Why? Because if the consumer is going to slow down, what else could occur? What's the next derivative? Also, a pretty stark difference is you have the Teslas, you have the darlings of the world over the last couple of years have really started to underperform. And you have dividend yielding stock, the traditional value stocks that are up on the year. So, like we've talked about in the past, looking at some of these indices like the S&P, looking at NASDAQ as a calibration for returns, the concentration risk of a couple of names in those particular indices really move the market or move the index. It doesn't really move often one's portfolio.
And Bob, when you say that, it's a great perspective because, over the course of the last couple of years. The highlights have been, you'd hear the Mag 7
Mhm.
and, we'd be doing, updates like this and, whether Bob, it was you and I speaking
Yeah.
or we were chatting with BlackRock or, we would, basically point out that, a good globally diversified portfolio is really, the right way to play the game if you're in it for the long game. And for our clients, we're in for the long game. We've never presented ourselves to be traders or timers or anything like that. And the reality is that we've been saying for a while that, a lot of the Mag 7, that they were trading at very high multiples. They were actually driving a lot of the return of the overall index itself.
No question. No question. When you look at, it's a stark difference this year. If you look at the return of the NASDAQ and the return of the S&P, and you would look at the return of an equally weighted index, is a stark difference from where that was last year.
And just to, for our, viewers and so forth, when we talk about, an equally weighted S&P, maybe just define that for them a little bit to give them some
So an
clarity.
one thing's when you buy the S&P 500 that you own effectively 0.2% in every name. Or if you buy the NASDAQ 100, you own 1% in every name. In all reality, these are something called capital weighted indices. So the larger a market capitalization of a company, that accounts for the weighting. So the market capitalization of the likes of Apple requires that to be a 10%, close to a 10% weighting.
And then you had
In
NVIDIA and everybody else.
exactly right. So when the bigger get better, it weighs more on the indice. When the bigger underperform, the exact opposite happens. And we've talked to our client base recently that have had a more concentrated weighting toward the equally weighting. And as an idea this year, if you were to have invested in the NASDAQ 100 as the beginning of the year versus the equally weighted NASDAQ 100 as of the close of business today, the NASDAQ 100 is down.
And for compliance
Yep.
purposes, we'll say approximately.
Okay. Approximately. Year to date, the NASDAQ is going to be down at about 4%. If you had an equal weighting of that, you would be down, you're up. And it kind of speaks to having a diverse allocation. I think more it speaks to when clients look at portfolios and tend to say one indices up, another indices up. Most of our clients have a very balanced portfolio and a concentration in small cap, mid cap, large cap, international. But they're utilizing the S&P under NASDAQ for a performance return.
Right.
Our clients' portfolios are much more diversified. Most notably, Europe's up this year. Eurostop is up almost 10%.
And I think one of the things also that people tend to do is, we have a term, we call it anchoring. And so what anchoring basically means is that we'll watch what's going on in the markets, we'll watch what's going on in the SP, the Dow Jones, NASDAQ, and we look at the height and we anchor to that as far as, oh, well, look at where it was so that, when the market is, let's say it was down 10% from that height,
Mhm.
the reality is that, but if I was up 20% last year, 20%,
Yeah.
and so those up years, when I'm anchoring only to the highest spot, the reality is that, most people are still, significantly ahead in what they've been doing over the past couple of years. And then the reality is that most clients have broadly diversified portfolios. And Bob, you and I, were talking about this previously, which is, the reality is that, in 2022, when interest rates went up and, the federal government raised rates in order to slow down inflation, a lot of our clients were starting to be very well compensated for the bonds that are often in the portfolios. So when somebody has an 80-20, it's 20% bonds. When they've got a 60-40, it's 40% bonds. And so a lot of these portfolios have adjusted over the last couple of years to have these bonds in the portfolio. And Bob, what we're also seeing is that we've seen interest rates starting to trend down a little
We
bit.
have.
And maybe share with people what that actually means for the bond side of the portfolio, because we're actually at a point where people are being compensated for the bonds that are in the portfolio. Having bonds in the portfolio provide also an additional lever or level of stability, especially when we're seeing some volatility like this. So,
Yeah.
Bob, maybe take a couple of minutes on
Yeah,
that.
when we went through a zero rate cycle, people didn't think they were compensated for the bond market. That, the idea of a 1 or 2% annualized return didn't move the needle. And thus, a lot of models went more toward alternative fixed income, whether it would be selling covered calls to get income or dividend yielding stocks, REITs in particular. And
And for some clients, or for many clients, the whole idea of having the bonds was just, even though we weren't being compensated in a yield, it was just provided that, a little bit more stability in where they were.
But it wasn't keeping the pace of inflation.
Correct.
And that was the biggest risk you
Absolutely.
had. Yes, there was safety associated with your cost of goods and services were going up far more than the return you were going to get on the bond. After we kind of came through that cycle, rates rose pretty rapidly. We got to overnight rates to just about 5.25 to 5.375%. Mortgage rates got back to 7, not appreciably different from where they are right now, but I think it gave our clients an opportunity to start investing in an asset from a security side where 5, 6, 7% on a relatively safe asset, investment grade bond starts moving the needle versus where it was at 2%. So to your point, I think more portfolios saw more bonds introduced over the last 3 to 4 years. And where we've come right now is I think the Fed acknowledges it got to the point where rates got to 5.375. They lowered by 100 basis points last year. What the Federal Reserve has a dual mandate, and that mandate is simply stated, one, to ensure that everybody who wants a job in the United States gets a job, and two, the cost of your wages are keeping pace with the cost of your expenses. That's the inflation. It's monitored by CPI. And traditionally, they use monetary policy to either slow down the pace of inflation or increase the pace of inflation.
I
Conceptually,
refer to as, it's kind of like the brake in the car.
no, that's a good
Just kind of
analogy,
like
right?
tapping the brake a little bit, raise rate, or take our foot off a little bit, let the car pick up some speed.
Yeah, because traditionally inflation is often occurs when people have cheap access to capital and jump in front of each other for goods and services. And by doing that, the Fed would hope that by charging banks more as to what they borrow from the Federal Reserve and then bank passing that on to their client, that would slow down demand and thus hit the brakes on inflation. So that's the traditional model. So we saw that occur. Coming into this year, there was approximately 2 additional 25 basis point cuts priced into the market going into 2025. As of us talking right now, it's getting close to 4.
And for our listeners, what that's really saying is the markets are usually projecting what they believe is going to happen in the future. So, when you see, interest rates and so forth, they're looking forward as to, what's going to happen in 6 months or so,
Yeah.
or stocks. And, it's a representation of what they think the future might have in store. And so,
Yeah,
as
so a good way to look at that, and sorry, is theoretically, if you were to invest in a government US 2-year note, you would be indifferent from investing every night at a floating rate or investing at a term rate. Well, if right now that rate is 4 3/8, the market tells you the average over the next 2 years is going to be about 3.90, which tells you the market's anticipating overnight rates dropping in the next 2 years. Probably will. I think it's going to be difficult to get what we call term rates go lower because with a $35-40 trillion deficit, we still have to issue a lot of debt. But we've seen the bond market do very, very well here in the beginning of this year. And as we talk about, when yields go down, prices of fixed rate bonds go higher.
So what people are seeing in their portfolios is, and as you just said there, Bob, is, if they own some bonds in the portfolio, the market value of the bonds may have shown increases over
Correct.
the course of what's been occurring. And then the other side of that is historically, when interest rates are going down, usually people start looking back towards stocks again, and
Yeah.
stocks usually start to
Yeah,
get healthier.
I've always kind of
hopefully.
felt lower interest rates kind of fuel some of the stock market, in
Absolutely.
particular small cap, mid cap that tends to be more levered companies. So we'll see if that's in the cards going forward. But I will say that we've come in this unique time when positive economic news often is negative for the equity market. You've almost want weak economic news, which means the Fed might lower rates, in which case that will give fuel to the equity market. So it's kind of been interesting reading some of these economic releases over the last couple of months.
And so the buzzword right now is the word tariff.
Mhm.
And so, we've with this new administration, this tariff conversation, and what you're hearing is reciprocal tariffs. And if you tax us, we tax you, and kind of going back and forth on that. And that uncertainty is what we're seeing kind of hitting the markets of recent, which is people getting afraid or being fearful of, wow, does that mean that the price of things are going to get expensive? Am I not going to be able to get something? Should I buy a car today and instead of waiting 6 months? And that uncertainty of what may occur is driving emotion. I always say is, the market goes either on fear or panic,
Mhm.
fear, or greed, one of the other. And right now, I think that, people are concerned. And so emotionally, we're seeing some responses in the markets.
Yeah, there's no question. I think tariffs in particular, just to frame it for the US in 2024 took in about $77 billion in tariffs, which sounds like a lot of money, but our total revenue is about $4.7 trillion. So tariffs account for less than like approximately 1.5% of our total revenue. Um, my personal opinion is I do think it's looking at it as a reciprocal tool, as a negotiating more than a real revenue generator or
Yep.
something that's going to fix the
And,
budget.
and and by the way, we've seen in these
Mhm.
conversations that have been occurring, certain things getting done. It's used sometimes as, I need you to do something. Sometimes it's actually used for the economic side of things, but there are different pieces that are going on and there's different strategies being used. By the way, that none of us really know the full
Yeah.
story, but we live with it. And if we tie ourselves to it, we'll worry because everybody's
Yeah.
glued to the news.
Well, there has been a significant imbalance of tariffs, and we know that as to where we stand as to what we get in tariff revenue versus when our goods going out go the other way. And I just think this um, cabinet wants to change things a little bit and make it more on a level playing field, and that's what they're shooting for.
And so, again, for all of our, for those of you who are hearing this, seeing this and so forth, I guess the event at the moment is, what tariffs may do in the future. But the reality is there's been, unemployment still reasonably low, when we
Yeah.
kind of look at it, and even though it's softening a little
Hmm.
bit, as far as that goes. Um, Things in general, corporate profits have been showing, pretty good,
Yeah.
so,
Yeah. Like the volatility that we've seen in the market over the last, let's call it month or so, and then accentuated today, has a lot more to do with what could happen.
right,
Unlike an event that we had talked about a couple of minutes ago, as to I could point to something and that happened
right.
and or occurred. So I think as we look forward, it is the administration's talking tariffs, how they kind of work its way into the system, who knows? I think the real concern is the consumer. And if Doge committee comes out, do we see labor and unemployment tick up? And I happen to think that the biggest concern people have would be stagflation, that we see the labor market underperforming with a higher unemployment rate, production slowing down, however, inflation being sticky. And then what do we do with that environment? Does the Fed kind of accommodate and lower rates? I suspect that they will. Um, in all reality, a 4% unemployment rate, we're not talking like a 5.5 or
Mhm.
6% unemployment rate. Moving the needle from like a 4 to 4.5 or maybe a 4 to 5 is probably healthy long term. It definitely helps labor inflation. More
Mhm.
people come back into the workforce. And I think it could be a good thing long term. Running at full employment is very, in my opinion, if you continue to run at full employment, it's inflationary because people can command wages.
Totally agree.
Yeah.
And also, we live in a time where information is instant and the media would love to keep our eyes glued to everything going on. So what I always tell people is like when you invest, it's a long-term gain. It's like, most of our clients are, saving for a home, saving for college, saving for retirement, saving through retirement. We're investing through all of those events. And none of them, by the way, are one-day events or two-day
Yeah.
events. They're long-term
Yeah.
events. And in those long-term events, there will always be volatility, which I'll share in a minute, a little bit more
Yeah.
clear for everybody. But what I say is don't lose sleep over
Yeah.
this.
Our client base are investors, are not traders. And that's how I
Absolutely.
look at it. Like people give us their capital and we take a lot of pride in like running people's money and it's an unbelievable responsibility, but we do it for a plan. We don't do it for a
Correct.
trade. And I think that's the biggest difference that nobody likes seeing the market being down but volatility is normal. And it's just when you have days like this, nobody looks at the days where you're up 1% or 2% or 3%. It's always the the down 4% days that kind of gets the
Right,
media's
because it
attention.
catches the headline
Yeah.
news. And I'm going to share something with people, and not that we're going to get into a detail on this, but the reason why I share it is just to give perspective. And so what I'm going to share is this, and I'm going to tell you, don't get too into the weeds on this, by the way. But if you look at oops, what did I just do there? Oh, there I am. So if we look at this, what this shows is if we look, say, from 1980, right through to, 2024, every time that you see this red on the bottom, that's an inter-year decline in the markets. So when we look at the S&P 500, which is this bottom chart, at any given point in a year, there will be times when the market is down for the year. Okay. Sometimes more than others. Okay. And so it's not a straight line up, because what happens is 75% of the time, let's call it, if we were just tracking the S&P 500, 75% of the time the market was up. And then it's to what level? But it's not just a smooth ride like that. It's doing this all year round, which is why I say that, we can't anchor our, site on the height in the market. And then kind of like when it goes down, it's like, oh my gosh, it's like we've got to kind of understand it's the long game that we're in for. And then if we recognize it in the long game that stocks historically have outperformed bonds,
Mhm.
okay, bonds, it's stability to the portfolio, it adds income and cash flow to the portfolio, then a well-diversified portfolio with a nice combination of diversified stocks, not just in the Mag 7, but
Yeah.
in equal weights and all different and international and so forth, along with a good bond portfolio. Those diversified portfolios that we put together, that we have our clients in, are really how we play the long game.
Yeah. I think philosophically, the best way to achieve capital, appreciation long term is a well-diversified portfolio into many asset classes that are constantly rebalanced. It's not, this looks cheap today. Do you rebalance if you have an allocation to small cap and that outperforms and that weighting becomes too much of a concentration in your portfolio? Absolutely.
But we don't do it that day.
Absolutely not. No.
It's not like we're trying to time the
Yeah.
day, the up, the down, and so forth. And so that was the reason why we wanted to, spend some time with everybody today, because we know that, from a headline standpoint, this is probably the most volatility the market's had in a day in a long time.
Probably if you go to NASDAQ, it might be the worst, the most volatile day since probably sometime in 22.
And so,
Yeah.
in doing that, just, to get some information out to everybody as quickly as we can, we just wanted to share some thoughts and some insights. And, it's like, I'm not worried. I don't think you were worried. And, we're not being, pompous or pious in any way, but, in, long-term portfolios, and when I say long-term is we're saving to and through retirement for people, saving for college, saving for home purchases and all the things that are important. It's not a one-day trade. It's not a 1 month trade. It's, we're here for you for the long game. And so, this too shall pass as we go through these volatilities. And, like when you look at this chart and you see, there's a lot of red that's on the bottom, which is, when that decline hit in the course of a year and at what level it hit. But then when you see across the top of, the bars of where did the year end, well, 75% of the time it ends up.
Yeah.
So, kind of keep that in mind and find some peace in that. And what I would say is sometimes also change the station, change the channel. I don't mean on us,
Yeah.
but don't get too caught up in, some of the headlines, and so it was interesting. There was the president made, had an address last week, and he said he said there'd be some disruption. And so this is, I think, a part of the disruption, which is the fact that we're going to see some volatility. Things are going to be happening, things are going to be changing, and we should expect that,
Yeah.
on a going forward basis. And this too shall pass, as we would say.
Yeah. And I think it's important to note that volatility is not directional. Um, for, often we come and we chat about the market on an off day. We don't do it as frequently on an on day.
Right.
And
I don't get a lot of calls
yeah, well, yeah,
on an on
but
day, but I
it is
do get a
important
few
to note
calls
that
on an off day.
you have good days and bad days. Today just happens to be one of the underperforming days. But if you were in the bond market, it was a great day. And that's why there's a diversified portfolio, because
So,
bond yields kind of dropped and prices of bonds went higher. So again, just volatility is to be expected. You know, people, if the equity market's going to compound at it, 7% a year, you're going to look over times. There should be years you're up 20%. There should be years you might be down 5%. And it's playing the long game rather than playing it as a trade.
Yeah, and I teach this a lot with our advisors and our teams, and I would say is the return we get, actually, we refer to it as a risk premium. We get paid for, accepting risk and riding out the volatility in the long game. Historically, we've done pretty well with it. So I just tell you that, find some peace in that. It was our pleasure to be with you, and have a great, day and so forth, and reach out to your advisor if you have further questions. So Bob, always a pleasure.
Absolutely. Anytime.
All right. Thank you.